Imagine this, waking up in the morning knowing your money is already hard at work. No alarm clocks, no bosses, just your investments quietly paying you. Instead of loose change jingling in your pocket, it's the soft chime of a dividend deposit hitting your bank account. Feels good already, doesn't it? Now picture this, a life where financial freedom isn't just a buzzword, it's your reality. A life where your money supports you, not the other way around. Here's the kicker, this isn't some far-off fantasy. It's actually achievable whether you want to make a little extra on the side or fully fund your lifestyle. Some folks get there by downsizing, selling their stuff, or relocating to cheaper cities. But there's another powerful option that often flies under the radar, dividend investing. With the right strategy, you could start earning as little as $50 a month and scale up to $4,000 or more, all from dividends. We're going to break down 3 fast-track strategies that can get you there. Whether you're starting small or thinking big, we've got you covered. So what's the magic formula to figure out how much you need to invest? It really depends on 2 things, your lifestyle goals and the income you're aiming for. The average person in the US might spend around $67,000 a year, but let's be honest, your number might be a lot lower or higher. If you're shooting for $600 a year, $50 a month, you won't need much capital. If you're aiming for $48,000 a year, $4,000 a month, well, that's a different game, but still totally doable with a plan. The key is flexibility. This isn't one size fits all. You're designing a lifestyle based on what you value most. Now picture this, your investments generate a steady stream of cash month after month without you lifting a finger. And your original investment? Still untouched. It's like owning your own money tree, one that keeps growing and giving. When you build a portfolio of dividend-paying assets, you're creating a system where your money earns money over and over again. So go ahead, visualize the lifestyle you want, and let's use the numbers to build a plan that gets you there. In this video, you and our friend John will learn how to start building a dividend income stream from $50 a month all the way up to $4,000. But before we get into strategy mode, let's make sure we're crystal clear on what a dividend actually is. Think of it like this, when you buy a stock, you're not just owning a little digital number, you're actually buying a piece of a company. You're now a shareholder, a part owner. When that company makes money, it has choices. It can reinvest in itself, or it can share the profits with its shareholders. That's where dividends come in. Dividends are those little thank you payments companies give to investors, usually in cash, sometimes in extra shares. Most of the time, these payments roll in every quarter. But some companies and a lot of REITs and ETFs pay monthly. That's where things get really interesting. Now let's talk about dividend yield, because that's the number that really tells you how much bang you're getting for your investment buck. It's a simple formula, annual dividend per share divided by price per share equals dividend yield. Let's say you own a stock that's worth $100 and it pays you $10 a year. That's a 10% yield. Easy math, but powerful results. Why does this matter? Because the yield helps you decide which investments are actually going to bring in steady income and how fast. Higher yields mean more cash flow, but they can also carry more risk. It's all about balance. Let's bring John back into the picture. John's goal is to build a portfolio that pays him every month, whether that's $50, $500, or $4,000. And he wants to do it without selling off his shares. By sticking with dividend-paying investments, John can generate a reliable stream of income while keeping his capital intact. That's passive income done right. So now that we've got the basics down, let's dive into the good stuff, 3 smart strategies John and you can use to build dividend income step by step. Strategy number 1. Covered call ETFs. Covered call ETFs are kind of like dividend superchargers. They combine 2 streams of income, regular stock dividends plus cash from selling call options. These ETFs buy a basket of stocks and then sell call options on them. That means they earn extra money from traders who want the right to buy those stocks later. The ETF pockets that premium and passes it on to investors like you. Some top performers in this category, XYLD, OLK, EWZ. These ETFs have been dishing out double-digit yields, around 11.8% over the last year. Here's the math. $50 per month, $5,000 invested. $500 per month, $55,000 invested. $4,000 per month, $480,000 to $500,000 invested. Compared to traditional dividend stocks where you'd need $1 to $2 million, that's a serious shortcut. Of course, there are risks. Call options can expire worthless. Stock prices can drop. No investment is bulletproof. But for many investors, the combo of steady income and strong yields makes covered call ETFs a powerful option, especially if you're looking to accelerate your dividend income. Strategy number 2, high-yield REITs. REITs or real estate investment trusts are another powerhouse strategy. These companies own, manage, or finance income-producing real estate, malls, apartments, offices, even data centers. They collect rent and by law must pay out at least 90% of their taxable income to investors as dividends. Translation: you get paid regularly, often monthly. A few high-yield examples. Two Harbors Investment Corp., 20.3% yield. Brandywine Realty Trust, 19.9%. Orchid Island Capital Incorporated, 19.4%. Using an average yield of around 10.8%, here's the breakdown. $50 per month, $6,050 invested. $500 per month, $55,000 invested. For $1,000 per month, $445,000 invested. And the bonus? Monthly payouts like a paycheck. But REITs aren't perfect. Their income depends on rental markets and interest rates. That's why it's smart to diversify across REITs or use REIT ETFs. With consistency and reinvestment, REITs can be a ticket to strong hands-off income. Strategy number 3, Dividend Aristocrats. Prefer stability over flash? Enter Dividend Aristocrats. These S&P 500 giants have increased their dividends every year for at least 25 years. Through recessions, crashes, inflation, you name it. Familiar names include 3M, Leggett & Platt, Walgreens Boots Alliance. They usually offer lower yields, around 6 to 7%, but they bring reliability. Let's assume a 7% yield. $50 per month, $8,500 invested. $500 per month, $85,000 invested. For $1,000 per month, $685,000 invested. Takes more capital than REITs or ETFs, but you're buying peace of mind and long-term growth. A smart move? Diversify across a few Dividend Aristocrats to reduce risk and smooth out income. These companies are often recession-resistant. Your dividend checks are more likely to keep coming even in tough times. So let's wrap this up. Whether your target is $50, $500, or $4,000 a month, you've got 3 clear paths. Heavy checkmark covered call ETFs for high yield and quick income. Heavy checkmark REITs for monthly payouts and real estate exposure. Heavy checkmark Dividend Aristocrats for steady, reliable growth. Your dividend journey can start with just a few $100 and grow from there. This isn't about being rich overnight. It's about building a system where your money works harder than you do. You don't need to be a millionaire. You don't need a finance degree. All you need is a plan, a consistent strategy, and belief. Start small, maybe it's $50 a month. Watch it grow. Reinvest. Stay consistent. Soon $50 can become $500, then $1,000, maybe even $4,000. Whether you're using covered call ETFs, high-yield REITs, or Dividend Aristocrats, you now have the tools to make it happen. Don't just work for money. Make your money work for you. See you in the next one. Smart way up.